Okay, I think maybe we'll just give people a few more minutes to get to arrive and settle down with their drink and their snack, and we can start in just a couple minutes. Anyone want to tell a joke or a story?
I was actually thinking about that last night, having a contest. I always do that with my team on Zoom meetings in the morning. We either have to do brain teasers or, you know. I do have a question. One came up, I just still can't believe. What bone in a baby's body isn't fully developed at birth?
Their head?
Nose.
Nose? What do you got, Gretchen?
What bone? Never developed. Well, I know your skull, that they have that opening. Maybe the skull was never fully closed or something?
Yeah, it's a good answer, but wrong. Oh, yeah. How we didn't notice this, what, in our babies when they're born, it's kneecaps. They're not born with kneecaps.
Oh.
Oh,
How do we miss that all those years?
I don't know.
no idea.
Does that blow your mind?
So
Yeah.
so when do they develop kneecaps?
After a year old, then they start developing, I guess, when they get walking and stuff.
Oh, okay. All right. Very good.
Some clients of mine are trying to get on, but they're on the Desjardins laptop, so they got shut down, like the blue screen of death.
Oh, that's not good.
Oh. Okay. So what are you guys thinking? How many people do we have on? We have a few people on, Melissa?
10.
Okay. Well, I think we should get started for those people who are here. And if you hear a voice in the background, that's Melissa. Melissa Thornton is my assistant, and she's handling the logistics for us here today. So thank you very much, Melissa.
Welcome.
So welcome everybody to our second financial empowerment event, strategizing and taking action for real estate purchasing. This is the second event that I have done. I did an event on March 4th that was a live event held in Whitby at a restaurant and went really well. We had a lot of, that particular one was women only, and we had a lot of attendees. We had about 66 people come, and we basically kind of just introduced some ideas that we're going to be expanding on today. And today's a little bit more about more specifics of, you know, if you made that decision that you do want to pursue real estate investing either tomorrow or a year from now, you're just at that stage where you want to take the next steps. We really want to help you along with this presentation today. And we hope that this very short commute that you had to your desk made it a little easier for you to attend. And sorry that we couldn't supply the drinks and beverages and snacks to you today, but hopefully you've picked something enjoyable. So let's get going. We're going to the next slide. So we want to thank you that you are here, and we're glad that you're able to be here, that you're feeling healthy enough. We hope you're all doing well. And there's a lot going on in the world, as we know, between the COVID epidemic, lots of issues in the world about equality and justice. And it's a really intense time now. And what we want to do today is let you take a little bit of a step back from everything going on out in the world or in your homes, and think about your future, think about where you were pre-COVID, and kind of moving forward on some of those things. And we want to help give you some motivation and inspiration to do that is kind of hard to come by. So we hope we can be part of that for you. We'd love it if you spread the word about attending today with these hashtags. And we're going to, ourselves, we'll be sharing some stuff after. So if you take any screenshots or you want to share anything about being here, we'd love for you to do that. So when we did this presentation previously, we were talking about the fact that we've had a huge increase in the price of homes, specifically in Durham region. In 2010, you could get a home for $290,000, 2010 being 10 years ago, and we've seen this 124% increase in just 10 years to an average price in Durham being $655,000. Now that was the price March 4th. That was this price, and we know there have been some changes since March 4th. A couple weeks after that, everything went upside down and everything changed. It's still a good time though to invest in real estate. And real estate, Melissa, if you show the next slide. There are predictions from CMHC, who does a lot of housing reports, that we are going to see some dips in pricing anywhere from 9 to 18% over the next little while. But that prices are going to recover starting in 2021. None of us know exactly, is that really going to happen? That's also a national average. So if you're in GTA, you may not see that. Prices may not go down that much. They may stay the same. Durham East, again, may not be as much. But the anticipation, of course, at some point we'll be through this and values will be regained and go up, because we don't have unlimited land. We have new immigrants. We have people looking for homes. So there's lots that's going on that's going to still make real estate a fantastic investment. And this might be the right opportunity for the first-time buyers or the first-time rental purchasers to get in when maybe we do see a bit of a dip in the prices. So today we have three of us presenting. Myself, Gretchen Casey. I'm a mortgage agent and investor specialist. Meghan, you can say who you are.
Hi, everybody. My name is Meghan. I'm a certified financial planner.
And we have Carolyn.
I'm Carolyn Maugeri. I'm a Desjardins agent in Ajax.
Okay, excellent. So Meghan is going to be talking to us. And Meghan, do you want to just share a little bit about who you are and take it over?
So I'm a certified financial advisor, and which is very similar to probably some of the resources that you may have available to you at the bank. But what makes me a little bit different is that I only work with the client. I don't provide any product. I only provide that advice piece. So I look at your individual situation, and based on what place you're in currently and where you want to be, I help you create a roadmap to do that. Oh, and I'm leading right now. So
You are. Go for it.
Okay, Melissa, you can just go ahead and switch to the slides. So when I'm helping somebody create their exact roadmap, I think that it's really important to take maybe some of the complex systems and complex strategies, but really bite them down into easy, simple steps, because there's a lot of things going on. There may be kids, there may be relationships, there may be other factors involved. And when you know where you're going and the simple steps that you need to get there, it just eases up on your bandwidth. Okay, so I've broken down my resource in terms of this presentation into two parts. The first piece, because I am an advisor that works pretty closely with real estate investors, I thought the first step I'll do is I'll just kind of cast the net and provide you guys with a couple rules of thumb if that's where your next right step is. So for the rules of thumb, when you're looking for a rental property, maybe you have an agent, or maybe you're just looking in the MLS listings right now. One of the rules of thumb to see if a property is even worth going to look at the open house, or even worth creating a spreadsheet and really crunching the numbers, is the 1% rule. So the 1% rule is, if the property is being sold right now for $100,000, you should be able to get $1,000 a month in rent. So it's 1% of the purchase price you should be able to get in monthly rent. And if I actually get a lot of pushback on this 1% rule, because a lot of people say, like, this just isn't possible in my area. And for that, I sometimes use the comparison of going grocery shopping at Canadian Tire. There might be food at Canadian Tire. There very well might be, but it's not going to be the same as going to a grocery store. So if this doesn't really apply to your area, it may just be that there aren't positively cash flowing properties in your area. The next rule of thumb is the 50% rule. So the 50% rule allows you to look at it a little bit differently. So this is when you could go into a property and say, how much could I get for rent on that property? And then what you do is you take half of that. So let's use similar numbers, easy numbers. Let's start with, you go into a property and you think, I can get $1,000 in rent from this property. If you take 50% of that number, and then you look at your mortgage payment, if your mortgage payment is more than that, then it's probably not going to positively cash flow. So then you have the opportunity to do a couple things here. You could maybe reduce your offer in terms of purchase, or you could put a larger down payment on the property so that your mortgage payments are less. So those are just a couple rules of thumb. Some of us might be looking for real estate, but not in terms of an investment, but more of something that you need to live in. Maybe you're not interested in being a landlord. Maybe you're not interested in that real estate piece. So for that, every client that I help, I walk through what I call a plan, where the P stands for prioritize, the L stands for lay everything out, the A stands for automate, because I'm a huge advocate for making things easy. And then the N stands for navigate, because it's once you have that system in place of your priorities, everything's laid out and automated, life always is changing. You're always going through a different stage of life. It's really important to revisit all of those other factors. The other thing that I like people to kind of keep in the back of their mind is every single family unit, every single person is different. So I am a mom. I have 4 kids. I run my own business. My husband is a teacher. Our numbers in terms of financial and T4 and like income may be very similar to a young professional couple that are starting. In terms of the T4 income, we would get pre-approved for a very similar mortgage amount. The thing to keep in mind is that I have a bunch of kids, and I have other obligations. I have a business that may not cash flow, as I think it would every month. So our numbers, although would be the same pre-approval rate, it doesn't really matter if I can't afford it. So that's where I say a really important piece is to find your balance number. A balance number is your cash flow. So I put a little graphic here. It's kind of hard to see because it's quite small. So if you have any questions, please feel free to put them in the chat or to reach out to me afterwards. The way that I like to think about your balance number is first you take your income. So and I like to think about this on a month to month basis. So the first of the month to the last day of the month. How much money is your family gonna bring in that month? Then how much money are you going to keep? So that could be things like maybe you're funding an emergency account, maybe you're funding a down payment on a house account, kids' education, all of those things. Put that down below in a separate box. Then I like to consider expenses. And you'll notice here, I don't know if you can read it, but there aren't any, I call them discretionary expenses here. Those are all expenses I've listed in the expense column that automatically get taken out of my bank account, whether or not I use my debit card or whether or not I write a check or whatever. Those are all expenses that happen without me even thinking about it. So my balance number, so what we're going to do is we're going to take our income, we're going to minus our savings, and then we're going to minus all of those automatic expenses. Automatic expenses like mortgage, utility, maybe you're paying rent right now, debt repayments, maybe you have some student loans, all of those things get taken out of the expenses. And whatever you have left is your balance number. And of that balance number, that's the number that you have available to you to do the discretionary things, like putting gas in your car, getting groceries, having some hobbies, going online shopping. So really being aware of what your balance number is super important, because even though my income might be very similar to another family's, our obligations and our expenses and what we want to use that balance number for might be very different. So that is a number and a tool that I think really helps you get ahead, and it really helps you evaluate whether or not your balance number meets your lifestyle goals.
Okay, excellent. So I know that Meghan, I met Meghan, I meant to say this earlier, actually, we met through Instagram, and she actually reached out to me and she liked one of my posts, and that's how we met, and we connected that way. And I went to her website, and she has many tools available, and PDFs and lots of freebies to help you. So I really recommend connecting with Meghan about your own situation, and she is an amazing resource. So Meghan, do you want to say anything else about connecting with you or anything like that?
Absolutely. I'm on every social media platform. So if you're not on Instagram, just feel free to find me anyway. I'm always here to answer questions, whether it's about, real estate is kind of my zone of genius, but I'm open to every question, whether it's about, the government benefits that you have available to you right now, like the CERB payment and the tax obligations. And maybe there's some, things that you've been thinking about in terms of, do I even have enough to maybe retire or fund my kids' education? Or how much should I put on a down payment for this house? Those are all really good questions, and I'm always around to brainstorm ideas.
Excellent. Do people have any questions that you can see there, Melissa? Any text questions, or would anyone like to ask Meghan some questions?
I don't see any as of yet. I just posted Megan's website to the chat group, so if anyone wants to check that out.
I do have a question.
Me too.
Oh, good. Sorry.
You want me to go first? Okay. So if you're talking to those people in Toronto where they have some excess cash and they want a rental property for the capital appreciation, more so than to cover the rent and expenses, how do you address that?
In terms of the capital appreciation, that can be quite speculative. So I think that the cash flow is, as long as their financial house, their personal financial house, can sustain a negative cash flowing investment, it's just something to be really mindful of. So you're buying something with the assumption that it's going to increase in value, which is, I don't have a crystal ball, so I can't tell you whether or not that's true or not. But in the moment that you go to sell it, it very well may not have appreciated to the level that you had expected. So, or it may be, you know, really exploding, and then it's almost like you don't know, you don't want to miss out because you don't want to sell it and then tomorrow it increases again. So I think having the cash flow that's been deposited into your bank account every month helps relieve that component of the purchase. So, and there are absolutely reasons for investing in a negatively cash flowing property. I have clients that have, you know, inherited a family cottage, for example. And so they rent it out in the summers or whatever. It's going, they're assuming the appreciation on the value of the cottage, but it's also really important to them. There's a sentimental value there. So investments aren't always just about money. Sometimes they're like a big, expensive heirloom. So there's all different kinds of situations.
Good answer.
And my question is about, you are unique in my experience compared to some advisors, in that you do talk about real estate and you understand real estate and rental properties and such. So do you, how does that work, and how are you able to do that when others, I think, you know, they haven't structured themselves to do that? So how are you able to do that?
I'm able to really provide some expertise in that area because I also have real estate. And when I first started, I felt like I didn't have anybody to ask. So when I first bought my first rental property, I thought I crunched the numbers. I have a pretty strong financial background. And when I went to the partners at the firm I was working at, they all told me that it was a bad idea. So then when I ran into my first issue, I had nobody to ask for help because they had already told me it wasn't a good idea. So I wasn't going to go back to them because they weren't going to help me navigate the problem. They were probably just going to tell me to sell it. So I think that for some people, getting into real estate, they didn't realize it was like buying a part-time job, which is something that I didn't consider. And I always recommend going to somebody who's a couple steps ahead of you when you're looking for your right next step. Like if you are a young mom and your baby won't sleep, you're not going to ask your friend who has a dog. You're going to go and ask your friend who has a baby who's maybe 2 or 3 that sleeps. So I think that,
Good analogy.
I think the whole reason I started my business was because I needed a me. Every time we had an issue with our rental, every time we doubted, one of our real estate decisions, it was like, well, let's just sell it. Let's move. Why did we do this? It's too much of a headache. There's too much whatever. And then I would have to take off that, Meghan, who's a human hat, and put on the advisor hat and be like, okay, what are the priorities? Let's lay it all out. What does it look like? And how do we need to change this? Or are we trying to change it based on an emotion? And hindsight's 20/20, right? You'd hate to sell something and say, should have kept it.
Yeah, good point. Okay, good. Well, thank you so much, Meghan. I think a lot of people are going to be connecting with you to get more info on how they can work with you, and you can help them with their specifics. So thank you so much.
Thanks for having me.
You're welcome. And next, Carolyn is going to talk about some tips and ideas that she has and how she can help you out. Carolyn and I had met, Carolyn, about how long ago? We met fairly recently, but because we had a mutual customer who knew both of us and who said we really would be great working together and helping each other, help customers together. And so we had connected, and Carolyn actually came to the last women's event, March 4th, and was also a great sponsor and brought some great vendor swag gifts for everybody who came to the event, which I'm very grateful for. So Carolyn, we'd love to hear what you have to tell us, and maybe just start with some stuff about you.
Okay, thank you. And thanks for inviting me. This is awesome. So I am a Desjardins agent here in Ajax, in downtown Ajax. So if you hear the sirens going by, I'm close to the Ajax Pickering Hospital, or whatever it's called now. So it's constant flow of traffic here on Harwood. Desjardins was acquired State Farm. So I was a State Farm employee since 1988. So there's a story behind the story. So, and financial planning is a really big part of that and why I stayed at the same company for so long. So I'm glad to be able to speak today. And I got some of the woo-woo stuff that I like to talk about. So that's really good as well. So if we can just move on to that first slide, that would be great. Oh, there's a different picture of Oprah. This is really good. I think it's really important when you're talking about finances to talk about your underlying beliefs. And Oprah said it best when she said, you become what you believe. You are what you are today in your life based on everything that you have believed. So when I was a little kid growing up, I grew up with a lot of instability financially. My parents did not hold on to jobs very long. It all looked good on the outside, but it was sort of crumbling. I used to say they were competing for T4 slips every year. So there wasn't a lot of money around the table, although we had lived in an affluent area. So I decided, they were also both alcoholics, and I decided that I was never going to do that. I was going to stay at one company for my whole life. And I basically have. It's been 33 years almost with the same company for me now. So kind of bananas. So I guess what I would say about that strategy is it did serve me quite well for a period of time, but it's kind of languished, I guess, that style, and I had the need to learn more and get better at finances as a result. So you just can't do the opposite. You sort of have to understand your beliefs and your why. Where your focus goes, energy grows. So a lot of people, just do not focus on the financial component, especially women. We're so used to giving to other people that we don't really take a look at our finances. So if you're saying things to yourself or hearing things from your background, like money doesn't grow on trees, and I'm so broke, and I can't do this because I need a budget, this session is for you, because you've got to look at those underlying beliefs and sort of understand. So the one thing I take clients through when I'm going through a plan, and I'm the opposite of Meghan, I do a little bit of financial planning, but I sell product. So we're a good partnership there. But I always ask people, what's your first memory of money? What's your money story? And for me, outside of this instability and everything, my first real memory is my parents I grew up in Markham with this bakery, and I used to get the bagels on Saturday morning for my parents. And I went one Saturday morning. I was really little too, probably 8 or 9. I can't believe they let me go there, but that's a whole other series of issues. But anyway, on the ground, I found a $10 bill. So this is probably 1973 or something, and I thought I died and gone to heaven. And obviously the right thing to do would have been to call the bakery or tell the baker and give the money back, but I didn't do that. And I took that money, I went to Woolworths, and I bought everybody in my family a gift and came home with the gifts, and my parents were like, where'd this come from, right? But that's a bit of my, one of the faults I have is I tend to give away like crazy and don't take care of my own financial house, which can get you into trouble too. So that's my first memory. So I would challenge you to just try and remember your first money story and your memory about money. So we learn a lot about, through our first jobs. Also through our parents, you know, how they were with money, feast or famine, and what that looked like in your household. A lot of families never talked about money. Sex and money people never talk about, and even in couples and relationships, you know, those are the things that people get divorced over. So it's important to talk about it, and maybe how you're different. So a lot of people are in that scarcity mindset, which is, you know, I don't want to lose anything, and you know, I can't afford this, and you know, there's some truth to that too. But what would it hurt to really just dream a big dream about what you can do and live in abundance? It feels much better when you talk in the terms of abundance and use that language. One thing I always say to people is, if your personal financial situation was a business, would you hire you to take care of the finances? You know,
That's a good question.
When you think about that like that, like people tell me all the time, I don't know where the money goes. Do you think the boss wants to hear that? Like, if you're the chief finance officer, I don't know where it all went. It just, you know, just goes away. So I think you have to look at it like you are the one in charge of this and direct the money. You tell, money is just energy, just like everything else in this world. You attract it and it grows, and if you don't pay attention, it'll all go away. So I don't mean to be militant and make it a whole big thing, but like, it is important to take that step. Also, like, who are your friends? Who are you hanging around with? If your 5 best friends are all, you know, facing bankruptcy and like spending money on lottery tickets and gambling and whatever else, you need to raise your standards to people that you can look up to. Like Meghan said, in her situation, she needed a mentor to tell her what she needed to do. So search those people out. And the other couple of questions, I just gave you some prompts questions, but the one I love is like, when you were 9 years old and you were totally unabated with like all of these realities of life and what you can't do, what did you want to do? Who did you want to be at 9 years old? So that's a really important question too, because oftentimes when you get that curiosity back of that 9-year-old, it leads you to your passion, which also leads to more money for you. So I encourage you to look at that as well. So my tips about creating confidence around money are a few fold. And the reason I got into this business was because I just wanted to keep getting better at it. And you know, I was really committed to that. So I took my CFP course as well. And I'm somebody that didn't even have like applied math. Like I had the general math, whatever they called that in high school. I didn't even remember bed math, and I had to do my CFP. So I had to relearn all that stuff because I thought there was some secret. But there really is. What I'm telling you here is the secret. There's nothing in that exam that was 6 hours long and only has a 50% pass ratio that's going to do any better than just working with these issues. So pay yourself first. So that's the most important guideline, is really before. People always say, oh, there's no money left over for savings. So if you automate, like Meghan says, and you pay yourself first, that's your paycheck, whatever it is, and your kids from a young age, if they've got a paper route or whatever it is, take it right off the top. So, and if you are in business, you should pay your profits first. The business is supposed to make a profit. Pay everything else after that, and then your expenses sort of work around that. So that's my number one sort of recommendation. The next thing is to pay your mortgage second and your insurance third. And the insurance is sometimes even more than the, you know, because it's the asset, it's sometimes more important than the mortgage. So we get calls from people that are getting their vehicles repossessed potentially, but they want to keep the insurance on it because if it's in a wreck, right, they want their lien holder wants their money. And there's the real repercussions when you become late. Our highest frequency of people that have claims are people that don't pay their bills. That's our number one factor. So you want to make sure, because you get extra surcharges if you don't pay your insurance on time. Okay, go in that order. Know your number, which is exactly what Meghan was talking about at the beginning, like understand your net worth. And that's the number to keep growing, right? Because even if you look at the one side, your income side, you're making $1 million a year and you're spending $1.1 million on like trips and vacations and sea-doos and things like that, then you're no better off than if you're making $50,000 a year. So that's really important to like keep growing that number. And one thing I do is every January I go through everything and look at that number and know what my number is. Get a side hustle. I did that for a long time. I told you I wanted to be a figure skater for many years. I taught skating on the side and made $200 or $300 a week, and it filled that passion that I had and also paid some bills. Selling your stuff is a big thing. I see people that are loaded down with high-end purses and things like that. And selling your stuff is a really good way to supplement your income, especially those obviously rowing machines and treadmills that aren't being used. My parents recently passed and they declared bankruptcy at the end of their lives, but they were sitting on $4,000 in gold that they never sold. So you just got to look around and remember sort of what you've got there too. The other thing is really cool. I just read about this. I don't know if you guys heard about this, but people in this time of where people are at job losses and have an income issue are renting out their pools for the summer. So because there's nowhere to go, yeah, you can rent out your backyard while you're not going to be there maybe anyway, a couple hours, so a family can come over and swim and have a nice afternoon. I'm like, this is the time where people get really ingenious on how to make money. I thought that was a really good one. Follow money on social media. That is a really easy way to get that language in your brain. There's budget moms that have all kinds of templates, and there's hashtags about wealth and growing money, following Warren Buffett, like anybody that you can think of. Having that in your feed is really helpful, just like anything else. And you can't take any more of the Kardashians. Nobody wants to talk about them anymore. Reading the good books on money. This is one I reread all the time. Total Money Makeover. Dave Ramsey has a YouTube channel. I'm sure Megan's read this one. Has anybody else, you guys read this one? It can be kind of harsh, but it's good.
I haven't read it.
Yeah, there's all kinds, the Wealthy Barber, that type of thing. It just takes some time to go through and reread that stuff. Of course, automate everything, get excited about it, and put a plan in place. So 30 minutes a month. Do you agree, Megan, with 30 minutes a month really is sufficient for people to take a look and have a money date and talk about money with their significant other?
I think 30 minutes is all you need.
That's it?
I think as long as you're consistent with it and you make it fun and easy, I think you can get everything you need done in 30 minutes for sure.
For having a mission statement with your spouse and committing that time over ice cream sundaes or something, that would really good. So it can be done. Yeah, it can be done. I mean, people like, if you follow some of these hashtags, people in the Dave Ramsey group, they paid, $100,000 in credit card debt off by using these strategies in a really short period of time and post that. So it's amazing when you put the energy into it. And it doesn't have to be as hard. It can be fun and exciting. You just have to change your mindset about it a little bit. So I want to talk a little bit about insurance specifically as it pertains to real estate, because it's obviously very important. Homeowners insurance is a requirement if there's a lender, for the mortgage. So don't just go anywhere. It's really important to know what you buy, because there's a lot of discount places out there that don't provide the basic coverage that you need. And insurance is like a parachute. You don't want to find out, like when you jumped out of the plane, whether the parachute is going to open or not, right? You really want to understand it. And pay for that coverage. And you want to stay with the same company, a good reputable company, because when you run into trouble, if you get a couple claims a year, in 1 year, you don't want to get canceled and then not be able to get insurance again. So we're finding there's less frequency in claims now, so less of the $3,000, $4,000 claims, but they're catastrophic when we do have losses right now. Most claims are in excess of $90,000, and water is the new fire. That's what we say. It used to be always fire insurance that people called it now, but really it's water damage because of global climate change. Also, you want to look at that liability component. So liability means the people suing you either on your property or in a car accident, somebody slipped and fell on your property, for example. You want to cover that off to the extent that you have assets. So if somebody, say, slipped and fell in your home and they sued you, you have limits of $1 million, but they sued you for $5 million, and you have properties or lottery winnings or whatever you have, they can have access to the excess for, $4 million up to what they're suing for. So it's something you really want to pay attention to. Also, tenant insurance is really important. So if you are going with a property that you're renting out to others, either a condo or a home, an apartment, whatever it may be, you want to make sure that they've got coverage for their content. So if there is something that happens in a small apartment fire, that they're not trying to go through your insurance, but they have their own insurance. And you can get listed on the policy, so if they ever canceled it, you would get notification. So and then you would also have your own rental dwelling owner policy, which would be a separate policy because there's different risks associated with that. And finally, the most important thing is to insure your life. You're the one that's paying the bills, so make sure that you have a good mortgage, life, and critical illness policy to prevent, if there's a catastrophic loss, like if you passed away, to support your family, or if you have an illness for critical illness, cancer, stroke, heart attack, that you would get a payout in those circumstances too. So those are my words of advice. I have a team here of 6 people here in Ajax, and we are able to quote home, auto insurance, business insurance, life insurance, you name it. And we have a great team, and we're not going anywhere. So and you get the personal service. Even though our door is closed right now, our hearts are open. We want you.
That's good. Good. Well, thank you. That is awesome information. Melissa, are there any questions that we have for Carolyn today?
No, we have a very quiet audience. I guess they're absorbing everything you ladies are sharing.
Okay, well, I actually have I know the answer, but I don't know if everybody else will. What's the difference between life insurance and mortgage insurance?
Oh, that's a very good question. There's a couple differences for sure. We call it mortgage life insurance just because people are familiar with that terminology. The banks have done such a good job of marketing that, right? But life insurance, mortgage insurance would pay off the mortgage. So basically the bank is the beneficiary. So if you said had a $500,000 mortgage, it would go straight to bank and pay that off. So that's decent. I mean, that's not terrible, obviously. It can be more expensive based on your own health condition because it's in a pool. So they get all the people that are smokers and have other excess health problems. Where life insurance is customized to your personal situation, your health is what it's rated for, so it can be a little bit less expensive. Also, if you have a mortgage, it's declining. So you may start out with a $500,000 mortgage, but it may go, by the time at the end of the term, if it's only say $50,000, they're only paying $50,000 in the proceeds. So if you get a policy through another insurance company, then it would be the $500,000. It would be paid out to your beneficiaries. And what happens a lot of times is people they want to stay in the home. They can cover the mortgage, but they want to take a trip with the kids to Disneyland, or they want to, pay for college for the kids. It gives you the flexibility to do with the money what you want to do, and doesn't just benefit the bank. So we always really recommend that as opposed to, we've never had a situation where, like, on a cost perspective, that they were less than what we had. And they also underwrite on the back end, right? So if you didn't answer one of the questions truthfully or to the best of your ability, they have an underwriting department that might decline your claim at that claim time, where we do it up front. All the medical and everything and assessment is done up front, so we'll always pay a claim. So those are some of the key differences.
Okay, good to know. Okay, well, thank you very much, Carolyn. I loved all your questions. When we were reviewing this ahead of time, I was really appreciating all of those, especially things like, when you were 9, what did you want to do? I never thought about that till you asked me that. Or, what did you, you were asking about, like, as a kid, what, sorry, well, I guess it's the same question. But anyway, I really appreciate those questions because they really bring up a lot of things that we need to think about how we deal with our life and our finances. So thank you so much.
Thank you.
Okay, so now I guess I'm going to talk about mortgages. My name's Gretchen Casey. I've been a mortgage agent for 15 years, and I love solving things. And I find that every person that I talk to, everybody's a little different, and it's putting the pieces together to find what's the right solution and to walk them through the process and make it easier, because sometimes it's intimidating. You're going to spend a lot of money, might be your very first time. You're hearing a lot of things in the news, and it's hard to figure it all out. So I love what I do and working with people to help them get into real estate. So I have a lovely team. Melissa is my assistant, and Bob, who is my fiance, is also my business development and sales manager. And I have 3 lovely children. Who, that's us in California at my parents' house, which we didn't get to go in April, but soon we will be back there when we're allowed to go. So that's me. So we're going to talk about some tools to get into the market. And I'm going to talk about a couple examples of clients that I've worked with and what their challenges were and what we worked on so they could overcome them to be able to get into owning a home. So the first person we're going to talk about is a client who's first-time buyer, Brittany. And Brittany had challenges, and she is and still is a beautiful young woman who really had ideas about how she could own a home. And she had a good paying job and some money saved, and felt like, hey, I should be able to get a mortgage. So she went to her bank where she had a bank account, and she was surprised to find that they declined her. So what her challenges were, the reason that she was declined, she wasn't being disciplined on a regular basis with her money. So she would travel for her work, and when she would be out of town, she wasn't setting up automatic payments, and she would miss payments and not realize that just one missed payment can make a difference on your credit score. And so busyness was a problem in terms of not taking the time to actually to sit down, to make a plan, to think it through. But fortunately, she had the ability to seek out people to help her. So I was happy to be one of those people. So if we talk about the next slide, kind of what did we work through? One thing we went back to was like, why did she want to own a home? It's really important to know why you're doing something, so that if you're sitting there thinking, boy, I could really I think I just want to go to the keg, even though I was there 3 days ago, and have another dinner. Well, if you go, oh, wait a minute, that's going to cost me $100, and I want to buy a house, and maybe I shouldn't be doing that. And why do I want to buy a house? Well, I don't want to keep paying rent, and I don't want to move back in with my parents, and I really want to have something of my own. I want a yard for my dog. So if you remember those whys and you keep them posted and you have ways to remind yourself, it's really helpful. The other thing I'd say is work from your goal backwards. So if you want to live in Oshawa and you want to be in a detached home, you can go on realtor.ca and find out pretty quickly, well, right now your purchase price is going to probably be between, the lowest I've seen lately is about $420, until, you can go up to 800,000 or more. So kind of start thinking about where do you want to be, and maybe you can't be in where you want to be. Maybe, so as an example, I've helped people where maybe they wanted to be in Whitby or Oshawa, but they're not able to afford that yet. So why not consider, maybe you're going to buy a rental property first and live with your parents for a while, buy that rental, get some cash flow going, and use that money, save that, and then get your owner-occupied property after, and that can work really well. And you might even, with your rental, you might get a joint venture partner or a friend to go in with you and use that as your vehicle. So be creative about creative financing to actually be able to meet your goals. An important thing with mortgages is debt ratio. So in her situation, she did have some debts that she needed to pay off. With talking about Brittany again, she also debt ratio is basically when you take your monthly debts divided by your monthly income, what is the percentage? So mortgages are, whether they decline you or approve you, is all around what are your debt ratios. Do you have a good balance? Like Meghan and Carolyn both talked about, are you balanced or are you not balanced? And do you need to work on having the right percentage so that you can get the approval? As far as a creative down payment, I mean, in her case, she actually had some money, but she wanted to save some more. So she was able to do something on weekends where she did have a side gig and bring in some extra money. So that really was helpful. Some other things you can do for down payments is there are a lot of early inheritances happening now where a grandma says, well, I want to give you some money now rather than later so you can get into your house. Sometimes parents are helping, they're being co-signers or they're being gifting funds to help people get in this market, because it is, if you're a single person, sometimes your income is a little bit lower than if you did have a partner helping you with the down payment. The other issue with the credit, so I mentioned that Brittany was falling behind on her payments, so that definitely hurts your score. A credit score of 680 and above is ideal, but you can get a mortgage under 680. 600 is the minimum, but most lenders nowadays want about 620 to 630, and that's an Equifax credit score. I do have a free app I can give you for your phone, and you can check your score and not have it hurt your score. So the three twos, I call it. So you should have your two trade lines, meaning like a credit card and a loan, or maybe two credit cards. You should have them for at least 2 years. And you should have your overall limits at least $2,000. So if you have two cards and one limit's 1,000, another's 1,000, that's good. If you don't have those three criteria in place, you might still, on an exception, get approved, especially maybe if you have a strong cosigner. Sometimes they'll say, everything else is good, but we don't think you're established long enough. An exception to that, though, is if you're a new immigrant, if you're new to Canada, they do make exceptions, and they will look at other circumstances, like, what was your credit, where you lived before, and stuff like that. So that's helpful for those people who haven't had time yet to establish credit in Canada. And the other thing, again, back with working with Brittany, I kind of became her accountability partner and helped her to look at what were her debts and how could she maybe cut out some of the expenses that she had and get back on track. And I strongly encourage people to have a partner to help you through, when you're looking at this, and if you're overwhelmed, if you don't have an actual, spouse or partner, make it, a friend, a parent, a professional that you're working with who wants to encourage you and keep up with you and help you to reach your goals, because they're so important to you, and it's important to have that. So next slide. So in figuring, sorry. So Brittany, very happy, same happy person she always was, but a little bit happier because now she did reach her goals. She saved, she got her automatic payments set up, and she was able to buy a house, and is very, very happy person. And she actually came to my women's event that I recently had, and it was, she's one of my great friends and supporters too. So the next type of situation I want to talk about is a couple. So in this case, Emily and Justin. So they already owned a home, but they wanted to get into owning an investment property. So they really weren't sure, having never done it, what do they need to do? What are the steps? And they had their own challenges as well. in terms of, you know, things holding them back. You can go next slide, please. They did have a down payment. They weren't sure, they didn't have extra money saved. They had a small amount, about 10,000, but that wasn't going to be enough to buy a rental property. They really weren't sure where to start, so they did need some help of looking at, you know, really everything. What is this going to cost? What's it like to be a landlord? Where do we start? What's good cash flowing versus not? And they were somewhat emotional, and we're thinking, you know, can we operate like a business, treat this like a business, not just, hey, this is a fun little thing to do because I saw it on HGTV, and not realizing this is a serious thing and you really should get all your ducks in a row. I could see Meghan and Carolyn shaking their heads because they are investors themselves, and they definitely can speak to that. So an important thing, back to talking again about real estate as a good investment. I mean, there's what's Einstein called the rule of 72. And the rule of 72 says if you take 72 divided by your interest rate or your rate of return, so in the case of real estate, your rate of return, that's the number of years it'll take you to double your money. So if you're investing in something like a GIC, which is a very low rate, under 2%, and you want to know what your rule of 72 number is, it's 41 years. So we'll take 41 years for you to double your money in with that type of interest rate, versus if you have your money in real estate or another higher earning investment, you're going to be looking at a return of 10%. So you could get your return on money, double your money in 7.2 years in real estate. So obviously a really good investment. And I know that Meghan talked about really you should focus on cash flow too, which is so totally understandable because the rates are not guaranteed with real estate. However, if you do your pre-planning and you look at the history and the area that you're going into, and you also, you know, you make sure that you know your numbers and you are buying something that is going to have a good monthly rent coming in compared to what you're paying on your mortgage, it's definitely a good way to go. Next slide. And again, it can also help you retire earlier or retire more comfortably. Also, something that I wanted to mention too at the beginning is, you know, it's a hard time now for a lot of people, and investing and making money isn't just about obviously getting stuff. It's also about, you know, a lot of people use that extra money that they're making to give back, whether it's maybe not just to their own children, their own family, but to their community, to give to charities, to be able to maybe spend some time doing volunteer work. So there's a lot you can do when you have more income and more money that is not as available to you otherwise. So with this couple, you know, it's kind of some of the same things as with Brittany, like going back to why are you doing this? And in their case, they wanted to, they both had parents who didn't have a lot of financial success, and they wanted to have extra money to help their parents at retirement. So that was kind of their why, not only for them, but for their parents. And for their growing family. They were going to have a baby soon, so that was important. And we talked about working backwards, debt ratios with rental income. So with rental income, most lenders allow you to use 50% of the rental income. That's what they count as income. They don't take 100%, they take 50%. And so Meghan was talking about that. Occasionally we'll have a lender will say, okay, we'll take 80% of the rental income, or we'll use something called an offset. So we might use a little more to qualify you. So you're taking not only your business income, but your rental income to help you qualify. So that does help, of course. And as far as, again, back on the creative down payment, I mean, you can have joint venture partners who, you know, they may be supplying some of the work on the property. They may be giving some of the down payment. You would have a joint venture agreement to then decide how do you profit, or are you going to hold on to the property. So that can help you if you don't have the cash sitting around yourself. You can buy a property And no, this isn't actually a down payment idea, but one idea is you buy a property and you use the, you put in a second suite. So you put in a basement suite, you get the permits, you do the work. So now it's going to be a 2-unit, and it's going to get a lot more income for the total property than you would have with just a single family home. So that's a really good strategy. So this is showing you about, in this case with this couple, they had equity in their home. So the house was worth $600,000, and they basically had a mortgage on it, but not a very big one. So they were able to take a bigger mortgage and borrow up to 80% of the value of their home. So they were able actually to have $140,000 by refinancing that home to put towards the down payment on their purchase. And it's funny because a lot of people who are, you know, homeowners for a long time, or, you know, they just don't totally remember the fact that, oh, I'm sitting on a gold mine. There's some money here that I can take out, I can use to build my wealth. And it's good debt, meaning it's tax deductible, and it's also helping you build your future. You're investing in your future. So that's a great way to do it if you have a home with increased value. And I'm just gonna let, so it's okay. Sorry, there's one more. I just want to see that one slide again with some of their, what we did together with Emily and Justin. I think we had a slide with showing the debt ratios, maybe. I just want to touch on that with the screen. Not yet? Okay.
No, it's
These were, yeah, do you have this slide that shows this, the screen when I'm doing an application?
Yep, I'll find it. 1 second.
Okay. While she's looking for that, I'm just going to mention that I love to supply lots of great information and freebies and things you can read on your own. So I do have, this is a booklet for first-time buyers. It talks about debt ratios, planning, every step along the way, what you need to know, picking a real estate agent. So this is available in PDF format. So if you, you're going to get a follow-up email after, but Megan will, actually, Melissa will share my email, and you can get this booklet. Quite extensive. How many pages? It's got 58 pages. And then I also have 3 other books that are more for investors. So one is on having cash flow. So if you're going to be having a rental property and you want to know about cash flow, this one's about quick cash. So if you're doing like flips, this is about how to quickly get some money from doing a flip. And the last one is about being the bank. So this is about if you have some money or you have a line of credit and you want to invest in private mortgages. Private mortgages earn you anywhere from starting at like 9%. So you like a 7% interest rate with at least a 2% lender fee, up to about 16%. Lending your money for private mortgages anywhere from 3 months to a year. And it's a great way if you do happen to say, I want to be a passive investor, I don't necessarily want to buy real estate. I'd be happy to tell you all about that. And I work with a lot of private lenders, and I have a lot of people needing the money, so I can marry them up and help people get the private money that they might need. So I just want to mention as well is what I love to do with people is show them actually on the screen, how do I know whether they qualify or not? And the way we know is the debt ratio. So if you see here, I don't know if it's big enough for everybody to see, but the GDS, which is 36.82, and this was Brittany Byers' case, and then the TDS. So those two numbers are what, when I plug in the income and the debts and the property tax and the heat and everything, I know that the GDS has to be between 35 and 39%, depending on your credit score. If it's over 39%, I know it's not going to work. It's too high. They're going to get turned down. Yeah, maybe we could go with like a private or alternative lender, but most people want to first see, can I get that best rate under 3% right now? I want to go with a bank. So in this case, it's 36%. So if they had with a 680 credit score, that's acceptable. So GDS is just the mortgage payment, the property taxes, and the heat divided by the income. The second number, which is the TDS, that can be anywhere from 42 to 44%. So the TDS, that is, if you add to that payment, the mortgage, property tax, heat, any other debts. So in this scenario, the person doesn't have any other debts, or else the TDS would be higher. But if, let's say, they had a car payment or a student loan, the TDS would be higher than the GDS. And so that's how I can tell right away, okay, your numbers aren't working. What are we going to do? Are we going to pay off the debt? Are we going to add a cosigner? Are we going to get creative? Are we going to, maybe instead of buying owner occupied, you're going to buy a Muskoka Airbnb rental and make the numbers work? So it's a lot of strategizing at that point of how can we make this work? Or do you just wait? Do you wait till you've got some more money towards your purchase or bigger down payment? It's not always, you know, you're going to do this tomorrow. It could be, hey, maybe we need a 1-year plan, and that's great. I'm not in any rush, and it has to work based on your life and where you want to go and what you want to do. So, but I love showing somebody when we, either in person or by a Zoom meeting, we go through it and then they can see right away, oh, okay, now I understand why it's not going to work. It's not just, you're not just making up things. It's all based on numbers and ratios. So, I think that's all I have today. Yeah, I guess I would love to invite anyone who's interested to talk further, to have a discovery session with me. Usually it takes about 30 minutes, sometimes up to an hour for going through your whole scenario, and I've got time to do that. That's what I love to do. And does anyone have questions?
There was a question from before, and I think it was, let me just expand it here. Hold on for a second. I think they were Carolyn. When you're talking about mortgage insurance and life insurance, the question is, does that mean you're going to get your house? The mortgage insurance is
Sorry, you cut out in that last part. What did you say?
Oh, sorry. If the mortgage insurance is paid to the bank to pay off the mortgage, does that mean that your kids or whoever you've designated to inherit your house, does that mean that they won't get the house? It goes to the bank.
No, the bank would just pay off the mortgage, and the house would go to, hopefully you had a will in place. If it was a spouse, it would go directly to the spouse. And if you had a will in place, it would go to that person. Yeah, but it would pay off that mortgage.
Great, thank you.
No fears there. They don't lose their asset. It really just gives the flexibility for the person to use the funds to pay for the funeral. You know, like you don't want to have a paid off house and not be able to have a proper goodbye for somebody, right? So funerals on average are about $25,000. I just went through that with my parents. Is like, and I sell this stuff, and I was shocked at how much it costs for a funeral. So.
Wow.
We have one more question for Gretchen. Hi, I'm working now, but a lot less hours due to the COVID situation. Can I still apply for my mortgage? Or a mortgage, sorry.
That's a great question. And I have a lot of people in that situation. So if you are still employed but less hours, at the moment they will use, as long as your employer confirms they're not going to let you go. So you get a job letter and they call the employer. They will use the lower number of hours to qualify you. If that's not going to be enough and you need that full-time income, you still could prepare. So let's say, it's a purchase and, we could still get you pre-approved, because they don't actually call employers for a pre-approval. So we could just get it all ready to go. We could get the rate held for 120 days. And then, you will know that before you actually get an accepted offer, you are going to need to be back to work by then, and it needs to be confirmed by your employer. So, good question.
Mm-hmm. I believe that is all of the questions at the moment.
Okay. All right. Well, thank you everybody for attending. Thank you to Meghan and Carolyn and Melissa for being part of this and helping to educate people and help people who want to know more about real estate. And we'll let you know about our next upcoming events by email. And you guys want to add anything else?
Wow, those are great pictures. That was really, it's so informative. You guys have helped me so much, even the last couple of days, just learning from you. So really appreciate it. It was awesome.
Oh, thank you.
Yeah, I also think like having the option to reach out to somebody and have these types of conversations, it helps you answer the questions you didn't even know you had. So like even hearing from both of you speak, it was like, oh, I never thought of that. So I think I mean, if everyone's here has already made a really great first step in the right direction.
Yeah, I agree. Fantastic. Well, we will be sending out follow-up email and to thank you and with contact information and a copy of this seminar. And thanks for being here, everybody. Thanks for the time. Take care.
Bye.
Good night.
Bye. I guess should we? I've actually never done one of these, so I don't know what you do at the